Buffett buys back record $5.1 billion in Berkshire stock as coronavirus hits operating earnings. Key points. Berkshire said it repurchased $5.1 billion worth in stock in May and June. The share repurchase is the most ever in a single period for Buffett, nearly double the $2.2 billion the conglomerate bought back in the final quarter of 2019. Those buybacks come during a tough period for some of Berkshire's wholly owned businesses as the pandemic thwarted economic activity in the U.S. and across the globe. Berkshire Hathaway announced on Saturday it bought back a record amount of its own stock during the second quarter as the coronavirus pandemic dented operations for Warren Buffett's conglomerate. The company said it repurchased $5.1 billion worth in stock in May and June. Berkshire repurchased more than $4.6 billion of its Class B stock and about $486.6 million in Class A shares. The share repurchase is the most ever in a single period for Buffett, nearly double the $2.2 billion the conglomerate bought back in the final quarter of 2019. In fact, the amount is slightly more than what Buffett spent buying back Berkshire stock in all of 2019. Despite the company's record buybacks last quarter, the Berkshire's cash hoard grew to more than $140 billion. Berkshire Class A and Class B shares plunged more than 19% in the first quarter and lagged the S&P 500 during the second quarter with declines of more than 1%. Those buybacks come during a tough period for some of Berkshire's wholly owned businesses as the pandemic thwarted economic activity in the U.S. and across the globe. Operating profits for Berkshire fell 10% during the second quarter, dropping to $5.51 billion from $6.14 billion in the year earlier period. The company also took a charge of approximately $10 billion from Precision Cast Parts, Berkshire's largest business within its manufacturing segment. Berkshire's investments in public markets gained $34.5 billion in the quarter. That gain caused overall second quarter net earnings to surge to $26.3 billion, up from $14.1 billion a year ago. However, unrealized gains from investments quarter to quarter are volatile and Buffett himself warns investors not to focus on that overall net earnings figure. The company is heavily invested in several companies that have rallied since the broader stock market bottomed in late March. Apple, Berkshire's biggest common stock holding, has nearly doubled since March 23. J.P. Morgan Chase is up more than 27% over that time period and Amazon has popped more than 66%. To be sure, Berkshire warned of the uncertainty presented to its businesses by the ongoing coronavirus pandemic, noting, "The risks and uncertainties resulting from the pandemic that may affect our future earnings, cash flows and financial condition include the nature and duration of the curtailment or closure of our various facilities and the long-term effect on the demand for our products and services." The company also said insurance giant Geico, which is owned by Berkshire, will likely see its underwriting results negatively affected by the pandemic for the rest of 2020 and into the first quarter of next year. Correction: this story has been updated to reflect Berkshire's operating profits fell to $5.51 billion. A previous version of this story misstated the figure.
If you compare the behavior of customers taking money out of their investments now versus in 2008, we've seen actually like a 50% reduction in people selling out of their investments this time around versus 2008. The primary driver of that is you've got many more people who have taken the time to put together an investment plan. So our data shows us that we generally have three types of investors in these types of markets. The nervous investors didn't take the time to put a plan together. The market sell-off scare them. The prospects of a tough economy scare them, and so they react to the market. So if we look back in history, going back 40 years of markets and examining sell-offs and then returns, if you miss the 5 best days, the return on your portfolio will be close to 30% lower than if you had stayed invested. If you miss the 30 best days, and again, we're talking about a 40-year period, 30 of the best days over 40 years, 70% less return on your money. Now, it's understandable that people get nervous, they get shaken, especially if you're new to investing. If you grew up coming out of the Great Recession of 2008. You saw family members really struggle. You saw people get very concerned about the market. Their 401ks came, down. People delayed their retirements. The confident investors with a plan, while they do want to check on their plan, make sure that they're invested the right way given their goals, are much more confident and much more likely to make small changes. And then you've got the bold investor who looks at this as, this is the opportunity I've been waiting for. One of the ways to become a bold investor is to think of your goals in sort of different buckets of money. Bold investors tend to have a bucket of money, cash on the sideline, that they consider to be opportunistic, and they can take risk with it. But what they also have are companion buckets of money. They have a bucket of money that will cover their essential expenses. They've got a bucket of money for emergency funds. And then they're very committed to and dedicated to long-term goals like retirement or saving for a house or saving for college. And so the bold investor tends to have a bucket of money that is truly, truly dedicated to being opportunistic.